Hello and welcome to The Trade. Before we get into the technicals, a quick look at what traders are watching. And US President Donald Trump has filed a $5 billion lawsuit against JPMorgan Chase and its CEO Jamie Dimon, accusing them of debanking him by closing several of his accounts. We should also point out that JPMorgan has increased Jamie Dimon's pay by some 10% to around $41 million US dollars. Meanwhile, the US has announced plans for a new Gaza rebuild from scratch to include residential towers, data centers and seaside resorts. And the Trump administration is allowing China to purchase Venezuelan oil, but, quote, not at unfair undercut prices. Joining us now to break down the latest moves across equities, bonds and oil and what they signal for Fed rate cut expectations is Ilya Spivak from Tasty Live. Great to see you, Ilya. The S&P 500 at or near these record highs. It certainly seems that President Trump backing off on some of his tough tariff rhetoric has calmed investors.
Very good to be with you, Juliet. And of course, not surprising, really. At the start of the week, we begin with the president saying that we might hit several European countries with tariffs. And then he shows up at Davos and winds it back. So not surprisingly, the markets like that. They once again get this feeling of the so-called taco trade, where the president basically asks for something unreasonable and then uses that as a springboard to negotiate down to something else. We've seen this with China countless times. We saw this with the tariffs last year. I suppose the encouraging thing here is that the markets were much faster out of sell America mode than they were after Liberation Day in April last year. But nevertheless, we've not made a new high on the S&P since October. And that was when the markets got a chastising from the Fed that they were over-extrapolating rate cuts. And these kind of episodes are exactly why the markets seem to want the rate cuts, because, of course, as your previous guest, Jeannie Dimon over at S&P Global just said, the numbers generally from S&P Global are looking pretty good. And we're going to get the U.S. numbers, and they're going to be expected to be pretty good. They follow ISM numbers that were very good. They follow third quarter GDP numbers that were very good. The pacing for fourth quarter GDP numbers looks like it might hit over 5%, according to the Atlanta Fed GDPNow model, so far as it stands now. But yet the markets can't make a higher high. And it's seemingly because the Fed is dithering on offering them all the rate cuts that the markets want, and yet we keep getting these types of ructions on the geopolitical front, now seemingly with faster amplitude. We have Venezuela, we get the attack on the Fed and Jay Powell, we get now this with Greenland. And so the markets break down earlier this week, they come back, but they can't make a higher high. They can't even undo the breakout from earlier in the week. And these PMI data loom and might give us fewer rate cuts when they're all said and done.
Yeah, Ilya, you touched there on a lot that's happened in a very big week, and particularly in the bond market with those JGBs. What is the 30-year Treasury telling us?
Well, this was that whole Sell America story. When we got the threat of tariffs around Greenland, we saw that once again, like with Liberation Day in April, the dollar and U.S. Treasury bonds and stocks all fell at the same time, as though the markets essentially went into sell America mode. So they sold assets tied to the U.S. We just saw with stocks, they steadied, they bounced, but they haven't overturned the breakdown. The bonds are showing you the same thing because, of course, when you get these types of episodes, investors start to demand extra yield to compensate them for the uncertainty, especially over the longer end of the time horizon in these 30s and the 10s. And so you get this elevated term premium in the bonds. It's not going anywhere. It's at the highest in several years in the 10-year. And so what you end up with then is this situation, seemingly, where the markets are not prepared to unclench. And perhaps it's because of rate cuts.
That does it for this edition of The Trade. Be sure to join us next time.